The following is a paid program. The views expressed are not necessarily those of the management or ownership of KSTP-AM 1500 ESPN.
This is the place to talk about everything related to the home, buying or selling real estate, financing and improvements that can help increase your home's value. This is Minnesota Home Talk on Score North. Here's your host, Jason Walgrave.
Hey, good morning, Twin Cities. You are listening to Minnesota Home Talk here, 1500 ESPN. We're here every Saturday, 7 a.m. to 8 a.m., talking mortgages, real estate, home insurance, credit repair, anything and everything dealing with your house. That's what we're here for. We'd like to take your calls and questions live on air, and there's a couple ways you can do that. We have phone line open. That number is 651-647-2910. So you can call in at any time during the show. We're going to answer your question live on air. Any question this morning is going to get you in the running for the tickets. We got a pair of Timberwolves tickets to give away. So the best question of the morning is going to win that pair of Timberwolves tickets. You can also text us at 612-234-7585. So again, that text number is 612-234-7585. If it's a little too early for you, haven't had your coffee yet, you can text in your question. That also gets you in the running for the Timberwolves tickets. So again, the phone line, 651-647-2910. And that text line, 612-234-7585. If it's your first time catching us, welcome. Appreciate you listening to us. You can also catch us on Facebook Live. And Evan, what else do we stream to? Facebook Live.
And YouTube.
And the
we have
YouTube.
a YouTube page.
What about Twitch?
No.
No Twitch?
Not yet.
No.
No MySpace?
No.
LinkedIn?
No.
Okay. The TikTok?
No.
What else? Instagram?
No.
There are so many social media platforms now.
How do you even keep up?
It's very difficult.
Like I would like to see someone like what their day looks like. Someone who's like addicted to the social media and they literally have an account, like every type that's out there, they have an account. Like how much time are you spending in your day? Just
hours.
Milling
Easily
through
hours.
there doing stuff, right?
Yep.
It's got to be, right?
Mm-hmm.
I mean, I don't even have TikTok. I got like one. I got like Facebook.
Yeah, I just use Facebook. Facebook, YouTube.
Yeah.
Just keep it
What
simple.
do you got, Evan?
I have all of them.
You have all of them?
No, I don't. I don't have a TikTok.
No.
Nah.
You're not doing your dance videos? I thought you used to do dance videos and stuff on the TikTok.
I did, but I just didn't make enough money.
Oh. Oh, I love it. So we are here. We're here answering your questions live. Anything and everything dealing with mortgages, real estate, credit repair. Definitely feel free to reach out to us at any time during the show, and we'll get your questions answered, and we'll get you in the running for the T-Wolves tickets. In studio with me this morning, Mr. Jerrad Havins with Credilife.
Good morning.
Local credit repair company here in Burnsville, Minnesota.
Yep.
No stranger to the show. Jerrad has been on the show many a times, giving us lots of great tips on mainly credit stuff, but also talking about how credit affects dang near everything in your life, right? You go to get a job, you're getting your credit pulled. Obviously, if you're going to buy a house, getting your credit pulled, any sort of financing.
Insurance.
Credit works all that. Insurance, Evan will tell you.
Yep.
True.
Credit plays a factor in how much your insurance is going to run you. It literally almost like runs our lives.
Big time. I compared a lot to fitness industry, because like many years ago, remember like a lot of times like clubs and the thoughts of like personal trainers and nutritionists and all these different things. It was almost like, some people would do it, take advantage of it, but it was like a booming industry, so to speak, right? It took a while for people to catch on and realize, well, this is actually extremely important. We should be doing all these things, right?
Right.
Credit's very similar. Credit for the longest time was, we've had a lot of clients, but over the years we've seen credit. I mean, if you look at like all these different companies like Discover and Capital One and Credit Karma and Experian, just constantly, like you'll notice for the past few years, like they've really ramped up the overall like messaging around credit and the importance of credit. And it just shows you like it really is that important, and it's something that people have to pay much more close attention to. They really do.
It's very, very important. Absolutely. It's also confusing, right? credit, it's crazy because we talk about it all the time. Credit, what's common sense in credit isn't common, I think was the quote that I heard the other day. Meaning that what you think would help your credit out actually can sometimes hurt your credit.
Yep.
And what you think would hurt your credit can actually be the best thing to do for your credit. And everyone's credit profile is like a fingerprint, right?
Yep.
There is no one size fits all type of solution or situation out there. It truly, there's a bunch of different factors. And unless you know how the scoring model works, I mean, it's like throwing darts at a dartboard, right?
Exactly.
It's like you have no idea what you're doing. You're just going to throw something out there to see if it works. That's where you guys come in.
Yep, exactly. I mean, and it's so powerful too, and it's just very positive. Like you guys know, I've been doing this for like 12 years now. I wake up excited. You know, even this morning I told you I was up before the alarm just to be on the show to talk about this. Like I get really excited about it. But it's really empowering, like when someone really takes like and invests in themselves to take their credit seriously, regardless of their starting point, whether they're in poor, fair, good credit, because you can always improve. But when someone really, dives into that and they understand like the power that it has for them, the amount of savings that they'll experience, the amount of opportunity that they'll experience, just overall peace of mind, because we understand like finances and financial stress is probably one of the worst stressors out there. I mean, it causes a lot of problems. So when you start to really hone in on your credit and to improve your overall financial well-being, it has a positive impact on your life as well. So those are the things that I get excited about, is helping people not only achieve their goals and their dreams, but just see the impact that it has in their overall lifestyle as well. Yeah,
it's so funny how credit works. I can kind of compare it to people selling their house in 2020 and 2021, where it almost seems like you couldn't do anything wrong. Your house might be worth $400,000. Let's list it at $500,000, and you might have got an offer at $500,000, right? It's one of those things. The problem there is on the credit side of things, you can do things wrong. You can hurt yourself. Just like a seller that wants to shoot for too high of a number on their house. Look, if you go out there and you overlist your house, you're not going to get any activity on it.
Yep.
And you're probably going to net less for your house at that point because you have to do price drops. And people are like, well, they're doing a price drop. Is there something wrong with it? You know what I mean? That gets the wheels turning of like, what's wrong with this thing? Why hasn't it sold yet? And so that's when you start getting lowball offers. So there is a way to do that wrong. Obviously, there's a way to do credit wrong too.
Oh, there's many ways. I mean, we're definitely going into that a lot of the show. It's like there's so many ways that you can take actions that would actually negatively impact you, where you're thinking you're doing the right decision, and so it's going to be really exciting as we're going through that, because I want to, on the show today, I want people to walk away with like some actionable items that they can do, that they could really put into play today, and over the course of the few weeks to like a month, you'll see the positive impact that'll have on your credit. So it's going to be really exciting.
So we got a lot to talk about today. We're definitely going to cover all that here in a little bit. Phone lines are open. So give us a call, 651-647-2910. That is the call-in number. The text line is 612-234-7585. We're going to give a pair of Timberwolves tickets away to the best question of the morning here. And we're going to answer your questions live. All right, so we're going to, let's see here. What do we got? We got some hot listings we're going to cover. And then we're going to circle back and we're going to talk a little bit more on the credit side of things. And we're going to talk about interest rates too and what happened this week with interest rates.
Why don't we start with that? Because I'm not quite ready for hot listings. I have to.
We can talk about rates, absolutely. So Thursday was a very exciting day, let's say, in the mortgage industry. When I say exciting, that just means that there was a lot of movement on stuff, and it ended up being a very busy day for a lot of loan officers out there. So what happened on Thursday is the CPI report came out. So CPI is Consumer Price Index. Mm-hmm. It's a measure that we use to check inflation. So it really just looks at consumer goods, gas, groceries, just your everyday stuff that you're buying. What's the price on those? Is it going up? Is it going down? That type of deal. There's always predictions of where it's going to be at. And so where it actually came in at was underneath the prediction, meaning that the cost of those goods was actually less than what was expected. So being that that's a measure of inflation, that would kind of allude to that inflation is coming down versus going up. And whenever that happens, that's good for interest rates.
Oh, that's good.
Okay. So our interest rates move 217 basis points in a day, right? Probably doesn't mean anything to you guys. You're probably like, what the heck does that mean? Like a typical daily movement for basis points is anywhere between, like, let's just say 15 and 25, right? So that would be like a typical day. So if you're outside of that, if you move like 40 bips in a day, it's a pretty big movement. 50 bips in a day, pretty big movement. We moved 217 bips for the better in one day.
Wow.
Which means that interest rates dropped 3/8 to 0.5% in one day. Right?
Yep.
Which is crazy. Like,
Yeah.
how does a 30-year fixed interest rate move that quickly? So that was Thursday, right? So that's what happened on Thursday because of that one report that came out, which no one was expecting, right? Everyone is expecting that, okay, inflation is still, it's not going like this, but it's still ramping up a little bit, and the Feds are doing what they can to kind of offset that. But it came in lower, then all of a sudden,
Oh, I'm sure everyone was busy. Lock in your rates, lock in your rate.
Well, pretty much everyone was locked already.
Oh, yeah, okay.
Right?
Okay.
Because interest rates are just creeping up. So it's like as soon as we get a purchase agreement, let's lock our rate because it's creeping up.
And I imagine you're doing like more extended locks lately too, right?
Right.
Is that really common?
Yeah.
Yeah.
So everyone's locking. Like as soon as we can lock, we want to lock because interest rates are floating up. Then all of a sudden, boom, you get the 1 day whammy and it comes down. And so then it's like, all right, can we reverse this lock and can we take advantage of that? Right. So that's what happened on Thursday. So, which is good news. We'll take it.
Yeah.
Right. We'll definitely take it.
Definitely.
We got interest rates sitting in the, the low 6s roughly right now for a 30-year fixed. Just last week at this time, we were sitting in, high 6s to low 7s.
Yeah. No, I love the reports that you send out.
Yeah.
I monitor those as you send those in, like just to kind of monitor where interest rates are at, just because, I think it's important for all the listeners to know too. Like when you go online and you Google what's interest rates at today, a lot of times those interest rates are very misleading as to how they're pricing those interest rates, like what it means to actually acquire that interest rate.
Right.
Whereas like what you send out is going to be more realistic to the standard consumer, right? So it's like, I think that's just being on top of it and understanding where things are at is so important. And that's a huge shift. I mean, that's a huge shift. If you only see like 15 and you saw 200,
right?
I mean, that's massive.
Right. I mean, we haven't seen that type of movement in one day since like COVID first was here.
Yeah.
Right. And the financial markets are like, what's this pandemic going to do to everything?
Yep.
In the entire world. Right.
Yep.
No one knows what's going on. So it's like, one little, whisper of something like this, all of a sudden it's like, and then you get something and it's boom. And COVID is weird. I mean, I remember I called a guy. And I said, look, your interest rate right now, this is at like 9 a.m. Your interest rate right now is at 4.5%. He's like, well, let's let it ride. Let's see what happens. Let's see what happens throughout the day here. So I called him at 4:30 that day. And I said, you're not going to believe this, but your interest rate is now 3.5%. It literally went down a full percent in one day because that's how crazy the financial markets didn't know how to react or predict or do anything because weird, we've never had a COVID outbreak pandemic before.
Yep.
Right? So outside of Thursday of this week, we have to go all the way back to when COVID was first here to see those types of swings on a daily movement.
Yep.
It's just crazy to me.
It's been a wild ride, even this year. I mean, the beginning of this year, when you saw everything creeping up, we've seen the shift in the market. I mean, it really happened quickly, and
It
so
did.
and then on top of that, I mean, what happened here recently is really good. That's positive news, just because, a lot of time, a lot of people I'd say are on the sidelines. Like we were talking about this morning, a lot of people are on the sidelines right now because they've seen the interest rates go up. They're not sure about the market. And so when these type of changes happen that are for the positive, I think that's a really good thing because that's going to let people like start looking at, okay, now that's a number I can deal with a little bit more. Let's look into this option now.
Yeah. Yeah, the world's not ending.
Yeah.
You know what I mean? The world's not ending. Everything is fine. And we knew this was going to we didn't know like we'd have a big one-day movement like this. My thought was we're kind of topped out where interest rates are at. We actually got up to about a 7.5 on a 30-year fixed. I figured that was going to be kind of our top. We're kind of going to just hold there for a little bit, and then it's going to do one of these where it's going to start coming down. It's great that we had a big day like that. Mm-hmm. More than likely, I mean, when you have any sort of major swing in that, probably early next week, we're probably going to lose half of that.
Yeah.
Right? But you're still talking 100 basis points in a day.
Yep.
At the net. So if you take the 217 that we gained, if we lose 100 of it on Monday and Tuesday, you're still 117 basis points up. Which is a good thing. So
that means lower interest rates for all.
Lower interest rates.
That's the message. Like, I always push this. You guys know it's like if there's anyone that's been sitting on the sidelines, it's like now is the time. Like really look into this option, especially with the interest rate change. Like understand what it really means, because a lot of times too the messaging out there is, I would say, almost like leads by fear. A lot of times, you know what I mean? Like people, I don't know if I don't want to get into politics or anything like that, but like a lot of messaging creates fear and inaction, I would say, right?
Yeah.
But the one important thing for people to do is really look at like the comparison. You sent out this, actually. This was another good thing that you sent out, where you were showing like just, a few years ago back in, during the pandemic, how people would go in, you'd price your home. Typically people were paying, easily 20 to 50, sometimes more above asking price, right? So you look at what you're now bringing out of pocket versus what you would have been. Even with the interest rates, and you do that comparison of what is today, where now you're getting the asking price or maybe even a little bit below.
Right.
You have sellers now contributing towards closing costs. Those are all things that people need to analyze and look at the real numbers instead of just focusing on just the interest rate.
Yeah.
Like when you start to piece that together, then you realize, wait a minute, financially, this still makes this is a good decision because I'm not coming out paying $50,000 over asking price. You know what I mean? Like,
Right.
There's so much to it. So I always encourage people, like, connect with the professional, work through the numbers, have clarity, and understand what it means for you. And then from there, decide you can make an informed decision. You're not like locked into anything.
Right.
It's more about just taking some time to understand and go, wait a minute, okay, we can do this, and I don't want to rent anymore. I want to buy a home, and it looks like I can. So this is great.
Yep. Yeah, there's two costs to buying a house. There's the cost of the house itself, and then there's the cost to get financing for the house.
Yep.
I think you got to separate them, because if you look now, okay, so, man, if we look at interest rates now, that's your cost, right? Basically is interest rates. Yeah, they're double where they were last year at this time. Last year at this time, they're at 3. Now they're at, let's say, 6.25, right? So, okay, so my cost on that side of the coin is doubled, but what's my cost on the house side of things? Well, like you said, now, if there's a list price out there, you could probably get the house under list price versus going 20 to 30 to 50 grand over.
Yep.
Right. And you can get the seller to pay your closing costs. Right. So now you've won hugely on that side of the coin. Right. So you got to remember, it's kind of like a teeter-totter. The lower the interest rates went, the higher that you had to pay for the price of the house. Right.
Yep.
So, it's on this teeter-totter. You're going to win on one side and lose on the other. That's typically how it goes. We're getting to more balance now where it was like, all right, I'm going to pay way more for this house than I probably should. But because interest rates are so low, I can afford it. Right. So now we're kind of getting back to that equilibrium.
Yep.
We're shifting back to this where almost like it's going to be like, man, now I can buy this house. Perfect example. I had a guy selling a house. So one of my clients is selling his house and he's buying a new house. He had his house listed at $450,000. He ended up selling it at $430,000. And paying $10,000 towards the buyer's closing costs. So he nets $420,000 on it. So $450,000 list price, he netted $420,000 on it. That buyer, if this deal would have went on in the spring, that $450,000 house probably would have sold for $480,000 or sold for $480,000. So $420,000 versus $480,000, $60,000 swing now. If you're the buyer in that scenario, you just saved yourself $60,000 on the price of the house. You're going to have to deal with the slightly higher interest rate for a little bit, but you can always refinance out of that when rates go down.
Yep.
Take advantage of a lower rate.
Yep.
So,
yeah, it's fantastic. I mean, this is good information. I can't push that enough. One thing that we're really excited about at Credilife too is that we're very motivated in working with people that want to buy homes. And so a lot of our programs are specifically geared towards that, helping get their credit there, but making sure that their financial position is in the best spot as well. So like the financial well-being, their credit, and then move forward for the home. So it's really exciting stuff.
phone lines are open, 651-647-2910. That is our call-in line. Again, 651-647-2910. The best question of the morning is going to win a pair of T-Wolves tickets here. You can also text your question to 612-234-7585. Again, 612-234-7585.
And we did have a text question come in from Andy. Andy asks, Mike, do you think supply of homes on the market will increase this spring relative to the lack of supply we saw last spring?
Will the supply go up? Honestly, I don't think so. I think if you look at our supply and demand in real estate last spring, I think we're going to repeat that. And a lot of people are like, you're not going to have that type of demand this spring out there just because of where interest rates are at now. I completely disagree. We have a ton of buyers sitting on the sidelines. Right? A ton of buyers sitting on the sidelines. I do think that if you look at interest rates now versus where they're going to be at in the spring, I think they're going to be lower in the spring, right? I think it's very possible that we are talking about interest rates hanging around the high fives in the spring, where right now we're in the low to mid sixes. So that's going to create a lot of demand. I think a lot of people are going to get off the fence and they're going to jump back into the market because that's typically what happens in the spring. So I'm predicting that we have we're probably sitting at about 9,000 listings right now, roughly. We're going to get all the way down to probably 6,500 listings or so in January and February. Now, remember, our lowest point that we ever hit was about 4,500 listings.
Yep.
Okay. But 6,500 is an ultra low number. We went into the spring market last year with about 7,000 listings. I think we're going to be at about 6,500 this year. We have just as many buyers that are going to want to buy this spring. I think it's going to be a repeat of last spring. Unfortunately, I think you're going to have to pay over list price again going into the spring, just like we saw. Because, again, so a lot of people are sitting on the sidelines. Soon as rates start with a 5, everyone's jumping back in the pool.
Yeah, if
everyone's
inventory is low,
in
demand is high.
Yep.
It's going to adjust to meet that demand.
So, and we were talking earlier in the show here. As far as demand goes, so what happens a lot is the average age of a first-time home buyer is 33. So what a lot of people do is you look back at birth rates 33 years ago, okay? And what were birth rates doing? Were they going up or were they going down? If we look 33 years back, the birth rate was here. 32 years, it was here. 31 years, it was here. And 30 years ago, it's here. So the next 4 years, we have a ramp of birth rates going back 30 to 33 years like this, which means that over the next 4 years, we have that many more people entering that first-time home buyer age.
Yep.
That many more people jumping in the pool. So obviously that's looking over a 4-year time span, but it's all starting basically now. And that's another reason why I think this spring is going to be a lot like last spring, because the demand is going to be there. We always have buyers there year in and year out.
Yeah. And I think it just naturally too, because I think about myself, as I've gotten older, you get a little bit older, you have a family. The reality is when you're going through that, you don't want to rent anymore. It's you just don't. You want to have your own home. You want your own home. This is just a part of life for most people. You know what I mean? Where it's like that. This is just the course that they want to go. So if you think about that, with the birth rates going up, 30 to 33 years ago, whatever that was, they've gone up. Well, yeah, there's going to be an increased amount of people that are into that age group. They're going to want to buy a home. They're moving on in their life. They have a family now. There's so much going on. So that demand's going to be there. And like you said too, if the interest rates do drop a little bit too by spring as well, that's definitely going to be enticing for a lot of people to jump back in and get after it. And then dependent on the inventory, if the inventory is still low, then the demand's going to be high, inventory low. We'll see that flip again.
Mm-hmm.
Yeah, it's the natural life cycle. You hit your 30s and you think, man, it would be really great to own my own place finally.
Yep.
And then you do that for a little while and you realize that it's awful. And then you're like, retirement. I'm buying a townhome.
Yeah,
it's the perfect split. Yeah.
Then you downsize, so you want a simpler life.
I don't want to do yard work. I want someone else to do my yard work. Townhome.
Yep. That's spot on. That's exactly how it goes.
So, question for you guys. So, do you guys like shoveling snow, stuff like that?
Sometimes I do, sometimes I don't.
You, Evan?
Define like. Do you mean, do I enjoy it as a legitimate thing that I look forward to?
Obviously, you're probably like, you know what? If I had the choice of, doing something else or shoveling snow, you're probably going to pick something else.
Yep.
Right? But I kind of like shoveling snow, to be honest with you, because I could just put the headphones in and kind of check out for a little bit.
It's a workout.
Yeah.
It's nice.
Get a little exercise.
Yep.
Feel you're getting something done.
See Evan's face over there is like.
See, I'm one of those people, too. I like to see my progress.
Yep.
You know what I mean? So, you got this driveway and you're shoveling it off and it's a satisfying deal, right? I can see my progress. I get it all taken care of. No?
And then you get it shoveled all into one area for your kids to make a fort in, a snow fort. And you know what I mean? That's also fun, too, getting it all prepped for them where when they wake up, it's like, yeah, let's get out there.
Yeah.
The best thing that's happened to me in my whole life was when Robbinsdale put in a bike path on my in my front, and they said, because we're taking up more of your yard, you don't have to shovel this. This is now the city's responsibility. I was like, oh my God, I don't have to shovel my sidewalk ever again. Sold. You can have the 150 square feet of my yard that you took up to make, because it's basically double width from where a sidewalk would be. But they're like, yeah, we'll come through with the brush thing, and it's not your responsibility anymore. And I'm like, yes, amazing. Now do the same thing in my alley.
Well, I was to say, did you put in a request to be like, yeah, do you want to just run that? You make that go up and down my driveway a couple times and then send it back out onto the main path?
You just got to make friends with the driver.
Yeah, see?
Yeah. I think that brush thing would struggle with my driveway, but it takes a load off to be able to be like, you know what? I don't have to shovel right away. Because if it gets icy out there and stuff, the city has claimed that that's their responsibility. They come through, they take care of it, and they do. But it's like, I no longer feel bad because I'm not out there shoveling day one. That's the real downside of shoveling. It's not the actual lifting of the shovel. It's it has stopped snowing. It is time to begin shoveling right now, which is life in the city. If you don't have sidewalk, your driveway is your driveway. You can leave it for a day or two if you really want to. But for me, I don't have that choice.
And and how often do you use the sidewalk? Probably never.
Pretty much.
Yeah. That's the other thing too. If you used it, you'd probably be maybe a different story there, but you're kind of like, I'm shoveling this thing and I literally never walk right there.
Well, I mean, I'm doing my part. That's the idea. But then, now I've done my part by giving up my sidewalk for a bike path.
Yeah.
And now the city takes care of it.
And you're
sounds like a fair trade.
Yeah, I'm happy about it.
Absolutely. Phone lines are open, 651-647-2910. Text line 612-234-7585. Taking your questions live on air here. You can text or call in. And the best question of the morning is going to win that pair of Timberwolves tickets. And you get your choice of games, too. That's the other thing. It's not like it's the next game or 2 games from now. You're going to have a couple-week block there where you can choose which tickets you want to use. Even cool. Even go down the road if you want a couple months down the road. That's fine, too. You can take your choice there. Again, call-in number is 651-647-2910. And the text line, 612-234-7585. Do we want to do hot listings?
Sure.
Let's load it up. All right, we are going to start in Shakopee. Yeah. We have a beautiful home here in Shakopee. I believe this is the biggest home we have in our hot listings. This one's at 2148 Kelly Circle in Shakopee, listed at $1.145 million. 5-bedroom, 5-bath, just over 7,000 finished square feet in this bad boy. 2.5-acre lot, built in 2003. Anything and everything that you would expect in a luxury home, this thing has it. And it's got the 7,000 square feet. If you need a social distance from your family, you can easily do that within the confines of your own house.
Social distance from the whole world.
It's a great house, and it's a great lot, too. It's on a private cul-de-sac. There's probably maybe, on this road leading down to the cul-de-sac, there's probably only like 6 or 8 homes on it. So it's very private, 2.5-acre lot. 2148 Kelly Circle in Shakopee, again listed at $1.145 million. Going to Minnetonka, got a newer listing here, 4627 Ellerdale Road in Minnetonka, listed at $975. 5-bedroom, 3-bath, 4,500 square foot home. This one is built in 1958, but it's been obviously updated and remodeled since then. 0.6-acre lot, so it's got a good sized lot as well. Again, this one is 4627 Ellerdale Road in Minnetonka, listed at $975,000.
Love this kitchen.
Yeah, they did a nice job on a lot of that house there. It is pretty spectacular. Going to the Wilds here in Prior Lake. This one is back on the market. 3113 Grouse Circle Northwest in Prior Lake, listed at $499,900. It's a 4-bedroom, 4-bath home, 3,172 square feet, sitting on a 1/2-acre lot, built in 2004. Very good price point to get into the Wilds here. So again, $499,900 is the list price. This one's at 3113 Grouse Circle Northwest in Prior Lake.
Just your basic 3,000 square foot house,
right? It's nice.
Yep. And the Wilds is a nice development.
Yeah, absolutely. Yeah, I like that. Nice and open. Got a bar in the wet bar in the basement there. Fridge, full wet bar. Newer carpet. Yeah, they did a lot of cool stuff in that house. Heading over to St. Paul. Got a good opportunity there in St. Paul. This one's at 1647 Ames Avenue. Listed at $329,000. 3-bedroom, 2-bath. Just under 1,800 finished square feet. This one's built in 1900, but again, does have some updates since then. Again, 3-bedroom, 2-bath, 1,791 square feet. Listed at $329,000. That's at 1647 Ames Avenue in St. Paul. Heading over to Newport. Another opportunity there. Newport, 1788 Hastings Avenue in Newport, Minnesota. 3-bedroom, 2-bath, 1,680 finished square feet. This one is on a 0.1 acre lot, built in 1942. Cute little home here.
Fully redone inside.
Fully redone. So, looks amazing. They did a really good job. Got the white trim, new flooring, new paint, new kitchen, cabinets, you name it. Pretty much everything was touched on the inside here. Good opportunity there. If you're looking to be... Excuse me, if you're looking to be in Newport, good opportunity here at Hastings Avenue. So again, 1788 Hastings Avenue in Newport, Minnesota. All right.
Next one is the Hive.
How do I get out of here? Oh, there we go. We got a business opportunity up in Aurora, Minnesota. We have the Hive. This is what, coffee and bakery? Coffee shop and bakery? Cafe, the Hive Cafe and Bakery. So you get the business and the real estate here. This one's listed at $590,000.
Bakehouse.
Bakehouse. So it's the Hive Cafe and Bakehouse here. Again, you get the business and you get the real estate there. It's on a 0.2 acre lot right there on Main Street in Aurora at 103 Main Street North. So if you've ever wanted to own your own cute little shop here, here's your opportunity. And it's turnkey. You can go in there, buy it. It's turnkey. Everything is ready to go.
It's rocking and rolling.
Again, it's called the Hive Coffee and Bakehouse up there in Aurora, Minnesota. Listed at $590,000. We have a lot in Merrifield, Minnesota, up on Upper Mission Lake. Listed at $139,000. So the lot size is 1.5 acres. So it's a nice sized lot there. If you've ever wanted to build a second home up on a lake, up north a little ways, this is a fantastic opportunity. So again, it's a 1.5 acre lot up in Upper Mission Lake. That's up in Crow Wing County. Again, listed at $139,000. Going over to Burnsville, we have a new custom home here. 13612 Sunset Hill Drive in Burnsville, Minnesota. Listed at $1.295 million. It's a 4-bedroom, 5-bath, 4,700 square foot home. Built in 2020. It's on a 1/2 acre lot. Anything and everything, again, that you would expect in a luxury home, this thing has it. Super cool on the inside if you're looking at the pictures there. It's got all the amenities, it's got all the upgrades. Super cool looking house. I could live there.
Yeah,
I'd live there.
I agree.
Look at that closet. Yeah, a walk-in closet in there. I mean, that's basically its own bedroom. You could turn that into a bedroom if you wanted to. It's that big.
It's very large.
Yep. Great home here
That'd
again.
be sweet to have a closet like that, actually.
Right?
It's kind of funny because you always think about like the wife always has the most, but in my case, my fiance Katie does. But I've been catching up. Like I'm running out of space.
He's putting in the work.
I've been putting in the work trying to catch up, and I'm like, wait a minute, I need more than one closet now. This is crazy.
If it's me, I'm using about maybe a quarter of that closet, and then the rest of it's my gaming room.
Oh yeah.
If my wife doesn't take it.
Yep.
You know, a couple beanbag chairs, set up a TV, the gaming in there.
Yep.
You know what I mean?
That'd be
See,
fun.
I was thinking that you just make it your secret weight room.
Do that too.
Just a a bench and a squat rack, and that's all you really need.
You know, then I put a little maybe just run some plumbing up there and just get like a little sink kitchen area. I wouldn't have to leave. You can make your smoothies, you can work out, I can game, and then I can get ready for work.
You put your little efficiency apartment, basically, right off your house.
So, Mike, you got this 5,000 square foot house. Why is everything in this closet?
Yeah, no, here's the meta plan, right? So you build your little efficiency apartment, and then you can list your home on Airbnb, and you can stay in the apartment.
Yeah.
Yeah.
right?
Have a secret door so that people don't know that you're there. Oh, yeah, now we're talking. This is more of a Halloween idea.
Yeah, right? I'm thinking like it's got its own entrance off the roof, right? It's got a little trap door.
Oh, yeah, you definitely need a
You know what I
secret
mean?
exterior entrance.
just- Come on down in there. Again, okay, so we got all
We
topics
should
there.
start our own building company and start making homes just like that.
Yep. 13612 Sunset Hill Drive in Burnsville, 1.295. Amazing home there. Let's go to Addison Drive in Prior Lake. Great opportunity here to own a house on a lake. This one is on Fish Lake, $775,000. 20755 Addison Drive in Prior Lake. 4-bedroom, 4-bath, 4,000 square foot home. 2.6 acre lot. So you got 2.6 acres right on Fish Lake with a 4-bedroom, 4-bath, 4,000 square foot home.
Finished walkout basement level with kitchen there. It's good stuff.
Great opportunity. I'm sure the seller will leave the mannequin there if they want to. You could probably build that into the deal. But this is a great house. I've actually been inside this house. It's a great house. It's a great house, and the lot is superb. And you get 2.5 acres. That's right on the lake. It's amazing. Again, it's at 20755 Addison Drive in Prior Lake. It's on Fish Lake, listed at $775,000. Let's go down to
Dundas.
Go down to Dundas. So commercial, big acreage opportunity here, 4.75 million, 130.6 acres in Dundas. It's right off 35 at the Dundas exit, just south of the Twin Cities here. Again, 130.6 acres, listed at 4.75 million. And then we have a string of Pebble Creek custom homes here. Let's just hit the first one. So, spectacular home here, as you can see. Huge 2-story home, listed at 1.299 million. This is a to-be built. This is at Quebec Place South in Savage. This one here is a 5-bedroom, 5-bath, 4,500 finished square foot home. It's a to-be built, so you can customize it yourself. This is a full acre lot, so 0.95 acres, just under a full acre lot here at Quebec Place South, and you can see the type of home that you can build on it. Absolutely amazing. Pebble Creek does it right. Again, anything and everything you would expect in a custom luxury home, this thing has it.
Yeah, just very basic finishings throughout.
Right?
Nothing too crazy.
Right? I mean, people walk into this thing and their jaws drop.
Yeah. Yeah, Pebble Creek makes some amazing houses.
So again, that one is at Quebec Place South in Savage. The one you see here, to be built, but you can get this one on a full acre lot for $1.299 million. So if you have any questions on any of these hot listings, or
We had one more.
we got one more.
Yeah, the one that you sent an email about.
Oh, sure.
Give me 1 second here.
Yeah, we got another listing here. So this one here is at 19826 Iris Way in Lakeville. Brand new listing that just came on, I believe, yesterday or the day before. $675,000. So this one is a 5-bedroom, 3.5 bathroom, 3,500 square foot finished home. 3-car garage, built in 2017. It's a great house in Lakeville. It's a great location in Lakeville. Not too far from Lake Marion there. Not too far from Lakeville South Schools. Great opportunity and a great location here for a house in Lakeville at $675,000, and it's basically new construction, built in 2017.
The internet claims that there is also a open house today
Open house today.
on this, starting at noon. So again, that's 19826 Iris Way in Lakeville. And you can check out all these hot listings or more at our website, minnesotahometalk.com.
Let's see. Phone lines open, 651-647-2910. Text line is also open still, 612-234-7585. Any questions dealing with mortgage, real estate, credit repair this morning, insurance, definitely send them in. We'll answer them live on air here, and we'll get you in the running for those tickets. Mm-hmm. All right, let's talk about, let's go back to a little bit more about credit repair here. So we're talking about how we want to give some listeners some tips. What can they take home with them today?
Yep.
Right? That will help them on their credit. So let's maybe just go through like your top 2 tips. If you're going to do 2 things credit-wise to help yourself, what's your 2 top tips?
For sure, step one is your credit card management. Credit card management, I'd say, is one of the biggest areas that a lot of people miss out on a lot of point potential just because they don't understand how to manage them.
Yep.
You know, so the biggest thing to understand is that if you're looking to improve your scores the most, like maybe you're looking to buy a home here in the future, maybe you're looking to buy a car, whatever it is that'd be credit related that you want to know what you're going to buy here in the near future, one thing that you want to do is you want to pay down those credit cards. And there's a perfect number. Now, actually, I know, you know the answer.
I know the answer.
But before you knew the answer, what would you say is the most common that you heard out there that people say how to manage your cards? What was like the most common saying?
You got to use them. I know you got to use them, and you got to carry a balance on them.
Yep. 30% is really popular. The 30% rule, I'd say, is probably the most popular out there. Is you got to use them, carry a balance. And they always say 30% rule. Well, here's the thing: the best ratio, meaning the balance that reports specific to the limit to improve your scores the most, is 3%. 3%.
3% of the limit. So if we're talking a $1,000 limit card, you're talking $30.
Exactly. And this isn't what you pay it down to. That's another common thing that people misinterpret. They think, oh, okay, so if I get my bill, I pay it down to $30. No, what you want to do is in the course of that month, you only want to spend $30. That's it. You stop. You wait for that bill to report, to get that billing statement, and then you go ahead and pay it off in full because the information on that statement is what reported to the bureaus. So that's how you got to control it. So you want 3%. That will improve your scores the most.
But I'm missing out on all those points. So if you're telling me I can only charge $30 a month on this $1,000 limit card, I'm missing out on points, miles, cash back. I mean, yep. I'm just not going to do that.
Yeah, so, and then there's a way that you can tweak it. That's a great question. So if you're a little bit, and this is more for like, it depends on the type of client, that we're coaching. Some people want to keep it really simple. They're not necessarily worried about the points. They're like, I just want to do the best thing. I want to keep it simple. In that case, they would maybe just do like Netflix, Hulu on it, something around the $30, and then they just pay it off in full every month. They're done, right? They just sit back and they know their scores are improving. Now, let's say you are someone that's a little bit more savvy, right? They want to take advantage of points and miles and all the different things. Maybe you're a business owner, whatever it is. So then what you want to do is you want to pull up that statement, your most recent billing statement. And what you want to look for is the billing cycle end date or the statement closing date. Those are the 2 key terms dependent on the type of credit card.
Okay.
So basically what you want to do is identify what that date is. Usually it's about 3 weeks before the due date. It's around 2 to 3 weeks before the due date is when they actually put together your billing statement, mailed it off to you, gave you time to make that payment on time, right? That's how it works. So what I say is 5 days before the billing cycle end date of that month, you want to pay it down, even if you have it maxed out, let's say, for all the points. As long as you pay it down multiple days in advance of that cycle end date, you can control the way it reports now. So you can still take advantage of your points, but then you pay it down to that 3%. Now you're taking advantage of your point potential as well. So your credit points and your perk points.
So I think that's a misconception out there for a lot of people is how that piece of it works.
Yeah.
Right? So a lot of people think that when I pull a credit report, that's the balance that you are showing on that card that day or at that time, right? That's not the case.
Exactly.
When I pull a credit report on my end, the balance that's showing on the credit report that I pulled was the balance that showed on your last statement that came out, which could have been a week ago, could have been 2 weeks ago, 3 weeks ago, however long ago that was. Your last statement that came out, that balance that showed on that statement, that's what reported. That's what's going to report on your credit report until the next statement comes out. Exactly.
And there's even a lag time between that. Because if you think about how data works, right? So like you have, let's Capital One, Discover, Chase, Citi, all these different ones. So these cards, the way it works is they report to the credit bureaus, right? So you have Experian, Equifax, TransUnion. All they do is take in data every single day, nonstop. They tie it to your record, and they basically sell that information for a fee. That's what they do. That's how they make their money. So if you think about your credit card and you get your statement, well, basically when they drafted that statement, that's when they shot that information up. Boom, it's going to go to the bureaus. But there is a little bit of a lag time there before it actually ends up on the report. So like every creditor is a little bit different. A lot of times larger ones, it's faster. But like, let's say you have a smaller card, you're building your credit. You have like a Merrick Bank card, or you have like a secured card or something like that. It's not uncommon for that information to have a lag time of 30 to 60 days.
Dang.
It could be that long. So it's important to understand that. That's why, like, if you think about it right now, let's say you're looking to improve your scores right now. You know, hey, maybe you're sitting at a poor credit standing. You're at fair. Maybe even you're still good. Maybe you're at 680, but you want to get to 720, and you're like, okay, I want to make some moves now to start popping this up. The best way to do it is what I just discussed. It's about your credit card management. 30% of your score is based on the revolving debt ratio. 30%.
Yeah, a third.
And so, and we just talked about the importance of timing of this is also very important because it takes time, right? So it's not about what you said. If you pay it down to 3% today and you went and applied for a loan today, it wouldn't reflect that. It's going to reflect what was previously reported on that statement,
right?
And a little bit of a lag time there. So the information is going to be dated, so it's important to know that. So if you start to make these tweaks now and start to tweak your management now in a matter of a few weeks to up to, let's say, 60 days, that's going to start to update finally on the credit report. Now you've taken control. Now you've boosted up your scores.
So quick example of working with a guy. He had like 3 installment loans and only 1 credit card. Okay. His score was sitting at about a 648 or something like that. And this credit card was maxed out. So he only has 1 credit card. It was maxed out. Now he would charge everything on that card throughout the month to get the points, and then he would pay it off at the end, right?
Yep.
So he came to me, he pulled it. I'm like, oh, here's the deal. Here's why your score is lower, is because this card is showing that it's maxed out. I pay it off in full every single month.
Mm-hmm. I'm sure it's the very first thing he thought about.
Yeah.
Why would it be that I pay it off in full every month?
Why does it show that it's maxed out there when I pay it down to 0 every single month? Told him how it works. If you wait till your billing cycle comes out, it's too late, right? Just because you pay that off in full right there, what's getting reported is that balance that shows on the billing statement. So I just taught him the trick. When does your billing statement come out? Make that full payment 5 days beforehand. That payment will clear. You'll have a 0 balance. Now the 0 balance will reporting. Literally, he did that next month. Score went up 81 points.
Yep, it's massive.
Like, that's how much it can move
Yep.
by making that one little change.
Yep.
And he does everything the same. He still charges all this stuff on that one card
He
through the
just
month.
changes the frequency now of when he makes a payment.
He just changed his payment day when he made the payment. And that's all it took.
Yeah, I know. It's amazing. I mean, so that to me is number one. Number two, a lot of times people, like, if you look up information about credit, they're going to talk about payment history. Payment history, 35% of score. Make your payments on time. Well, I would say that's probably a given. People probably know they should make their payments on time. So that's not going to be my tip number 2.
Okay.
My tip number 2 is about having a credit mix. Just like you talked about, you need to have multiple accounts, different types of accounts being managed correctly. When you have like a more diverse portfolio, let's say, like within your credit report, your scores will go up. Because lenders, if you think about it, when you're applying for a loan, what is it that you want? You want money.
We just want them to make the payment.
Yeah, you want them to make the payment. The consumer, the person applying, wants more money, right? So ultimately what we're doing is we're showing the ability to make payments on time and show the ability, like when you have multiple different types of accounts, we have more bankability, more credibility. It's like, well, I feel now comfortable as a bank to lend you money because you have multiple accounts all in good standing.
Right.
You have different types of accounts all in good standing. I feel comfortable lending you money because you appear to be someone that'll pay me back on time. That's really how this all works, right?
Yep.
So having a credit mix is huge, especially like what you talked about. If you were to only have, let's say, 1 credit card and 3 installment accounts, you're missing out on that mix, which is why there could be such heavy swings. And then they're also missing out on some potential points over time by not having an appropriate mix. So so everyone write this down that's listening, unless you're driving, then go back and watch on demand and then write it down. But what you want to do is you want to have at least between 1 to 2 active installment accounts. So like an auto loan, student loan, could be like a credit building CD account. Those are really popular now. Something that it's basically something that you take a loan out and you have a fixed term to pay it back over time.
And if you own a house already, your mortgage is an installment account.
Exactly.
So you already have that on there.
And that's a top tier installment account. So that's a really important one if you have that, which is awesome. So you want 1 to 2 or more, but 1 to 2 I'd say is like a baseline. And then realistically, you want to have at least 3 active revolving accounts. So 3 credit cards. If you could have at least 3 to 5 is like a nice little sweet spot for most people.
Yep.
Then, and you do exactly what we talked about in the beginning. If you start to manage those correctly by having that 3% reporting, I mean, the potential point that you can have like to improve your score is massive. But here's the most important piece to me is you've now built a credit profile that is it's viewed in a very good way by lenders. You're really putting your best foot forward when you build it up that way.
Yep. And we were talking about one of our topics for the show, or the topic for the show is how to get the best interest rate on your home.
Yep.
Credit score is a huge indicator of what type of interest rate you're going to get.
Yep.
Every sort of interest rate that you see advertised out there is based on top tier credit.
Yep.
If your credit score is underneath that, interest rate's going up.
Yep, exactly.
So no, that's a great point. So a lot of people, I had one person come to me the other day, so I'm just going through here, had 6 open credit cards, and a couple of them were just store accounts, right? I got a small Macy's card that I opened up a few years ago, and I got that. She's like, I really only use one card, so I'm just going to pay off the balances on those other ones and cancel them because I don't want that additional credit hanging out there because it looks bad that I could get in trouble, that I can charge all that up. Mm-hmm. And I was like, no.
It's like,
no,
stop.
I'm like, look at all the history you've had on there.
Yep.
Perfect payment history, no late payments on 6 different cards. I said, as soon as you close those cards, all that history goes away.
Yep.
I said, your score is going to go down.
It's going to plummet.
So I said, that's completely fine. Pay them down to 0. Don't use them. That's fine. Leave them open. Eventually, they're either going to close due to inactivity, or they're going to say, hey, you need to use this card, otherwise we're going to close it. They'll give you a little heads up. At that point, go buy a pair of socks.
Yep.
You know what I mean?
Yeah.
Use it, buy a pair of socks, pay it off right away. Boom, you're good to go.
Yeah, I mean, that's a really solid point too. Like, for people out there, if you do have multiple accounts, let's say you have multiple, like, universal credit cards, and you have some store cards that are more specific to the, the store that you're going to, that's not an uncommon thought that people have, is like they've built up and they have multiple accounts and they know they're going to apply for, let's say, like a mortgage. It's not uncommon for them to think like, well, I don't want to show that I have too many, and it might show that there's risk because I have all this available credit that I'm not using. So that's what their mind is thinking. Like, if I show that I have all this available credit, that should be a risk to them, because that means I could not only get this loan from you and now charge and max all this out, right? And that's not how they look at it. The bank is looking at it going, hey, wait a minute. If you show all this good positive history, all this wonderful length of credit history, and then on top of that, you have low balances, you're actually someone the lender wants to work with.
You have the ability to go put yourself in trouble and
you choose
max
not to.
out a bunch of cards, but you have chosen not to.
Exactly. So it's about habits, right? You talk about this a lot. Your credit report is an indication of your financial habits, right?
Yep.
So that's what they're looking at. It's a very advanced algorithm. That's why it's another thing too. Like, anyone that's gone through this, if you've gone through a financial struggle in your life, and you've started to get your credit card balances are going up a little bit, and your habits are changing, what happens a lot of times is credit card companies will reduce the credit limits. And I've had so many clients reach out to me going, well, why would they do that? I've had this card for years. I've never been late. Well, the reason why is that the algorithm is so advanced that these credit card companies will ping, and they'll look for risk mitigation. If your financial habits seem to change, showing risk, it's not uncommon for them to lower the limit so they can reduce their risk.
Right.
So that's how advanced this really is. So people need to understand, like, the tips that we're giving you right now are more general and very positive. If you're not doing these 2 tips that we talked about, you should do them now. But you have to understand that the FICO algorithm, on top of, like, and there's many variations, is extremely advanced. And it's really looking at indication of your financial habits and how you manage debt. That's what it's looking at. So, like, once again, if you can show that positive length of credit history, multiple accounts open in good standing, that's a very good thing for you, because now you're putting yourself in the best position for lending.
Evan, can we talk a little bit about insurance?
Sure.
Okay, so we've been talking about this. So we talked about how your credit score will affect interest rates. We mentioned that your credit score then will also affect insurance. Like, what type of swing are we talking about? If you're talking about, hey, I'm in a, let's just say I got a 640 credit score versus a 780 credit score.
Depends on the carrier, as always. But some carriers, it can be a humongous swing. I have seen when I run reports on someone and they have poor credit, their rate go up by 30 or 40%.
Dang.
Yeah, it can be a humongous difference. And that I've talked about this before on the show. What it really comes down to is if you have a lower credit score, they figure you have less liquid assets, and so you are more likely to make a claim, a mid-size claim. Everyone's going to file a claim if their house burns down. So that's just based on the statistics of the area. No one is going to be like, well, I can afford to rebuild this house.
Yeah, I don't want my premium to go up, so I'm not going to file a claim on my house that completely burned down.
Yeah,
to the
exactly.
ground,
That $1 million claim. Well, no, it's those like $10,000 claims where they think, my washing machine leaked water all over the basement or whatever. Those sorts of things that fall into that category of, is it worth filing a claim? Maybe, maybe not, because, I'm going to be paying higher rates for the next 3 or 4 or 5 years. But if you have poor credit, they're relying on the fact that you probably have less credit to rely on or liquid assets. So the choice is going to be much more straightforward. I don't have a choice. I don't have the 10 or 15 grand to carry this right now, so I'm just going to file the claim, and I will pay the higher rates. Yeah, I lose my claims-free discount and all that stuff. No big deal. That's what insurance is for. And to be clear, I agree. But the companies know this, and they will price that into the rating.
So I think a lot of people think the reason why they pull credit is because they just want to see if I'm going to actually make the payment on insurance or pay my insurance company the premium when it's due.
No.
But that's not the case. It's more of, is this person more apt to file a claim or not?
I mean, that's just it. Insurance is different than loans in this regard because ultimately speaking, if you don't pay the insurance company, that's no skin off their backs. That's between you and your loan company and stuff. You don't want to have insurance on your house. That's fine. That's fine. You'll be okay. That's just it. It's if you're not paying your premiums, then it's not their problem anymore. Yes, obviously they would like to have a nice stable interest pool and so on. But, there are plenty of people who do struggle to make insurance payments on time and so on, and they will pester you. They have legal obligations to you as a customer and a client. But ultimately speaking, if you don't have a policy at the time of a loss, it is not their problem. It is your problem. And so all those things lead up to the fact that what they're really interested in is how likely are you going to have a claim, like something that is going to happen, and how likely are you to file a claim on that loss? Those two things are all they really care about.
I mean, it's data and stats.
Yep.
Probability.
Yep.
There's a lot of math going on in the back of all this stuff.
Yes, indeed. Ooh.
Right. That's the end of our show here, folks. We appreciate you
show.
listening here. We're here every Saturday from 7 a.m. to 8 a.m. answering your questions live on air. Anything dealing with mortgages, real estate, and credit repair. We appreciate you tuning in. We're going to be here next week as well. So we hope you tune in and listen to us at that point. We wish everyone a great weekend. Enjoy the cooler weather we got going on. And we'll see you next week.
This has been a paid program. The views expressed were not necessarily those of the management or ownership of KSTP-AM 1500 ESPN. You're listening to 1500 ESPN on KSTP-AM 1500 and 94.5 HD2 Minneapolis, St. Paul.